So if you've ever looked into investing, there's probably a chance that you've heard the exact same advice over and over again. That's just buy an index fund. Financial advisors say it, millionaires say it, heck, even Warren Buffett recommends it. Even people who know almost nothing about investing seem to know that you're supposed to buy an index fund. But here's the problem, no one ever actually tells you why you should do this. Instead, they're throwing around words like ETF and mutual fund, expense ratios, diversification. And if you're just getting started, it kind of feels like everyone's speaking a different language to you. So today, I'm here to fix that. And hopefully by the end of this video, you'll know exactly what an index fund is, how it actually makes you money, and why so many wealthy investors recommend them, and whether they're actually worth investing in. And trust me, they're way simpler than people make them sound. So let's get into it. Before we can begin to understand why everyone recommends index funds, we first need to understand what they actually are. So let's imagine something that's completely unrelated to investing as a whole. Picture that you're in high school. Let's say that there are about 500 students. Now imagine that someone asks you the question, how smart is the average student at your school? You probably wouldn't interview every single person at the school. You also wouldn't just pick one random student and assume that they represent everyone, because maybe that student is the smartest person in the school, or maybe they're failing every class. Either way, one student doesn't tell you that much about the whole school. Instead, you'd want to look at the performance of all 500 students together. That would give you a much better look at the average. Well, the stock market works almost the exact same way, but instead of students, you have companies, thousands of them. Some companies are doing amazing, some companies just flat out aren't. And instead of trying to guess which single company wants to be the next Apple, people created something that's called an index. And basically an index is simply just a list of companies that's used to measure how a group of stocks is performing. And one of the most famous examples of this is the S&P 500. But despite the name, it's not actually a company that you can buy, it's simply a list of 500 of the largest publicly traded companies in the United States. These are companies like Apple, Microsoft, Amazon, Nvidia, Google, Costco, Visa, and there's hundreds more. When people on the news say the S&P went up today, they're talking about how the companies performed as a larger group. Now, here's where index funds come in. Instead of trying to pick just one company, an index fund simply buys all or a representative sample of the companies in a particular index. So if you invest in an S&P 500 index fund, you're not betting everything on just Apple, and you're not betting everything on Microsoft, but you're actually buying a small piece of hundreds of companies at the exact same time. You can think of this like ordering a pizza. If you order a pizza with only one topping, you better hope that everyone actually likes that topping. But if you order a pizza with a variety of toppings, you're kind of spreading things out. And if one topping isn't your favorite, the entire pizza is still pretty good. That's basically what an index fund does. Instead of putting all your money into one company, it spreads your investment across hundreds of businesses at the same time. And that's one of the biggest reasons why people love them. Now let's say that you decide to invest all your money into one company. Maybe it's Tesla, maybe it's Apple. Maybe it's that next company that everyone on TikTok is saying is going to explode. If that company has an incredible year, great, you can make a ton of money. But what if something unexpected happens? Maybe sales slow down, or maybe a new competitor shows up. Maybe the CEO makes a controversial decision. Or maybe the entire industry has a rough year. Suddenly, your investment could lose a lot of value because all of your money was riding in one company. Now compare that to someone that owns an S&P 500 index fund. If one company struggles, it's usually a small part of the overall fund. The other companies continue going about their business as usual. Some will go up, some will go down, and some will probably stay about the same. Instead of depending on just one winner, you're investing in the overall performance of a large group of companies. That concept is called diversification, and that's a big word, but all it really means is not putting all your eggs in one basket. And in investing, that's generally considered a smart way to reduce your risk. So now you know what an index fund is. But here's the next question for you. If you're buying hundreds of companies at the same time, instead of trying to find the next big winner, how are you actually making money? Because that's obviously the part that everyone wants to know. Well, there are actually two main ways. The first is called capital appreciation. And don't worry about the fancy name and the fancy title. It just means that the value of your investment goes up over time. So let's say that you buy into an S&P 500 index fund today, and over the next few years, the companies inside that fund grow. Apple sells more iPhones, Microsoft signs more customers, Amazon delivers more packages. All of these companies become more valuable. Their stock prices generally increase. Because your index fund owns these companies, the value of your investment can increase too. Now, here's something that's important to understand. The stock market doesn't generally just go up. Some years it has incredible returns, while other years it goes down. That's just the way that it works. If you've ever watched the news during a market downturn, then you've probably seen some scary headlines like the stock market crashes, investors lose billions, worst day in years. And that's enough to make a lot of people panic. But here's the interesting part. If you zoom out of all of that and look at the market over decades instead of just day by day, the picture looks very different. Historically broad US stock market indexes have trended upwards over long periods of time, even though they've gone through recessions, wars, inflation, financial crises, and countless periods of uncertainty. That's why long-term investors don't obsess over what happens on a random Tuesday. They're looking at it in years, not just hours. The second way index funds can make you money is through something called dividends. Think about it like this. Imagine that you own a small business and at the end of the year, the business makes a profit. Well, you have two choices. You can keep all the money inside the business to help it grow, or you can take some of those profits out and pay them out to the customers. Many public companies do this exact same thing. Some companies choose to pay part of their profits out to their shareholders, and those payments are called dividends. Since an index fund owns shares in hundreds of companies, it can receive dividends from many of them. Depending on the fund and your account settings, those dividends can either be paid out to you directly or automatically reinvested to you to buy more shares, because now those new shares can potentially earn returns of their own. It's kind of a lot like compound interest, check out my last video on that, except instead of interest from a bank, your investment is growing because of market returns and reinvested dividends. That's one of the reasons why long-term investors often choose to reinvest their dividends instead of just spending them. So why do so many successful investors recommend index funds instead of trying to pick individual stocks? Well, there are a few big reasons, and they're pretty simple actually. You don't have to spend hours every day reading earnings reports, and you don't have to stare at stock charts, and you don't have to guess which company is going to be the next big thing. You simply invest in the market as a whole. Second, they're diversified. Remember the saying, don't put all your eggs in one basket? That's exactly what an index fund helps you avoid. Instead of relying on just that one company to succeed, you're investing across hundreds of businesses operating in different industries. Technology, healthcare, banking, retail, manufacturing, energy, consumer products. And if one sector has a rough year, another may be doing well. And third, they're pretty inexpensive. Most index funds have very low fees compared to many actively managed funds. That may not sound exciting to you, but lower fees means that more of your money stays invested in the market. Imagine paying someone 1% of your investment every single year, and it might not sound like much, but over 30 or 40 years, those fees can add up to tens of thousands of dollars if you're investing right. Many index funds only charge a fraction of that number. And while fees aren't the only thing that necessarily matters in this situation, keeping costs low is one of the few factors investors can actually control. Now, you might be wondering, if index funds are just so great, why doesn't everyone just pick stocks instead and make even more money? Well, some people absolutely do. There are professional investors out there that spend their entire careers researching companies. They have a team of analysts, they have access to expensive data, and they have years of experience, but even then, consistently beating a broad market index over long periods of time has proven difficult. And that's one of the biggest reasons that index funds have become so popular. Instead of trying to beat the market, many investors are simply trying to own the market as a whole. Now, we can actually make this a little more simple. Imagine that there's two friends, Jake and Alex, and they each have $5,000 to invest. Jake decides that he's going to find the next big stock to invest in, and he spends hours on YouTube, reading articles, checking social media for the hot picks. Eventually, he puts all of his money into one company because he believes that it's going to explode. Well, Alex takes a different approach. He invests his $5,000 into a low-cost S&P 500 fund, and now, could Jake end up making money? Yes, absolutely, but if he happens to pick a company that skyrockets, he could outperform the market. But what if he's wrong? What if the company that he chooses struggles or the hype dies down and a competitor comes along? Alex doesn't have to worry about any single company by itself because his investment is spread across hundreds of businesses. He isn't trying to guess who's winning. He's betting that over time, many successful companies together are going to continue to grow. And historically, that has been a strategy that has worked well over long periods, even though there are no guarantees for the future. So at this point in the video, you know what an index fund is, and you know how it makes money, and you know why so many experienced investors decide to go this route. But before you go open a brokerage account, I do want to talk about a few mistakes that I see a lot of beginners make, because avoiding these mistakes can be just as important as finding the next right investment. The first mistake I see is that people think they're going to get rich overnight from this. I hate to break it to you, you're not. I think that social media itself has completely changed everyone's expectations, because every day you're seeing videos like this stock is about to 10x, turn $500 into $50,000, the next Nvidia. Well, that's incredibly rare. Most long-term wealth isn't built from finding one magical investment. It's actually built by consistently investing over years, sometimes even decades. And obviously that's not super exciting, but it's a lot more realistic, and if you're expecting to double your money by next month, you're probably going to end up disappointed. Now, the second mistake that I see is trying to time the market. This isn't day trading. People often say things like, I'm waiting for the market to crash, or I'll invest once prices go down. And the problem is that nobody actually knows when the market is about to go up or go down. Even professional investors struggle to predict when a market moves. And while you're waiting for the perfect time to move into the market, your money isn't doing anything. It's sitting into an account. Again, check out my last video. And there's an old saying in investing, time in the market beats timing the market. In other words, that means that being invested for a long time has historically mattered much more than trying to perfectly guess the best day to invest. Now, the third mistake that I see is panic selling. This is probably a term that you're familiar with thanks to social media, but let's say that the market drops 15%, or maybe even 25%. And the news channels start talking about a recession, your portfolio might go down, and your first instinct might be, I need to sell before I lose everything that I just put in. But here's what history has shown. Markets have gone through crashes before. We've seen the dot-com crash, the financial crisis, the COVID crash, and much more. And don't get me wrong, none of those were fun to live through, but over long periods, the market has recovered from these downturns. Selling during a panic actually locks in your losses. Long-term investors generally understand that the market is going to decline, and that's a normal part of investing. However, that doesn't mean that future recoveries are guaranteed or that they're going to happen quickly, but it's one reason that many people focus on long-term goals instead of short-term headlines. Now, the fourth mistake that I see is waiting too long to get into this. And I hear this all the time where I'll start investing when I make more money, and I'll start after college, I'll start once I get a better job. The problem is that the longer that you wait, the less time your money actually has to grow. Even if it's only $25, $50, or maybe even $100 a month, getting started is usually much more important than waiting until the right time when you're ready. Now, this is probably the question that you've been waiting for so far in this video. If you've been convinced that index funds are a good investment for you, which one should you actually buy? And there isn't obviously going to be a correct answer. There are several excellent options, and one of the most popular ones is going to be the S&P 500 that we just previously talked about. These funds track approximately 500 of the largest publicly traded companies in the United States. Depending on the brokerage that you use, you might see names like VOO, VXAIX, SWPPX, IVV, SPLG. The most important thing to understand is that these funds all aim to track the same underlying index. That means that their long-term performance is often very similar to each other. These differences actually usually come down to things like fees, how they're structured, and how brokerages offer them. So don't get yourself caught up in trying to think that you're magically going to become rich overnight while others won't. For most investors, choosing a low-cost fund and consistently investing is far more important than obsessing over tiny differences that you see. Now, to actually make this video practical, buying an index fund is honestly much easier than most people think. First, you'll need a brokerage account, and there are plenty of well-known brokerages that allow you to buy these index funds. Once your account is open, you transfer money into it, then you search for the fund that you want. You choose how much you'd like to invest, and then you review your order, and pretty much that's it. Many brokerages out there even allow you to automate your investments. For example, you could automatically invest $100 a month, and you don't even have to remember to do this. You don't have to think about it, and it happens automatically. And for a lot of people, that's one of the easiest ways to stay consistent with your investing. Now, here's the big picture. At the end of the day, an index fund isn't some secret investment that has been gatekept and kept a secret. It's actually probably one of the largest known investment strategies. And that's exactly why so many successful investors recommend it. Instead of trying to outsmart the market, you're actually participating in it. You've become one with the market. Instead of chasing the newest trend, you're investing in hundreds of established companies that are already known to be consistently making a profit. And instead of hoping that that one stock is going to change your life overnight, you're giving your money the opportunity to grow steadily over time. It's not flashy, it's not going to be exciting, and that's honestly kind of the whole point of this. So why exactly does everyone recommend these index funds? Hopefully now you know the answer. They're diversified, they're low cost, and they're simple to understand. And they've historically been one of the easiest ways for everyday people to invest their money for the long term. That doesn't mean that they're risk-free. The market can and it will go down. But for many investors with a long time horizon, they're a straightforward way to build wealth without trying to predict which company will be the next big winner. Now, if this video actually helped you understand what an index fund is, I do ask that you consider leaving a like, because it really does help the channel. And if you're interested in learning more about money, investing, career paths, and personal finance explained in pretty simple terms, make sure that you subscribe. It's free. I post new videos every week designed to make finance less confusing and actually help you make smarter financial decisions for yourself. And before you go, let me know down in the comments, if somebody handed you over $1,000 today, would you invest it all at once or invest it gradually over time? I'd love to hear your thoughts on this, and thank you for watching, and I'll see y'all in the next one.